All right, guys. Hope you had a good weekend. Enjoyed homecoming festivities. We've got a lot to talk about, so I need to throw out some announcements real quick. So, if you were not here on Friday, I didn't record this part, but I wanted to make sure everybody was aware. I am changing the score for the number of points that's available for the presentation. The reason for this is not to make the presentation worth more, to make everybody panic. I expect everybody to do really well in the presentation regardless, but the problem is that the way things are set up right now, my scoring scheme will not work. Like I said, 70%. You should be able to get a B in the class. You will see that it's currently at a C, and that becomes a lot more pronounced the higher you get up. Like if you were angling on 85% for an A, that becomes even more problematic. So it's like a percent and a half for an A. So I wanted to try to find some extra points to do that. My best option was to make the presentation worth more. So let's go ahead and just fix this over and say 5 like that. And well, it didn't do much at all, did it? Let's see. That's better. Okay, there we go. So yeah, again, presentations, I generally grade the presentations pretty lightly. I'm not going to focus too much on the vocal characteristics. If you stumble, things like that, I'm mostly interested in the content. If you're really concerned about doing well in the presentation, I strongly recommend that you read my guide on oral presentation. It's on Brightspace next to the oral presentation rubric. It's based on my interpretation of all the rules. If you follow those rules, you will get an A. That's all that I can tell you. That's for the group, obviously. Obviously, you want to think about it from the present or individual perspective, but also if you don't follow those rules, you probably will not do as well. But I take those rules very seriously with respect to the presentations. And that's basically the best perspective that I can give you on that. Let's see. What else do I want to talk about? Oh yeah. Let's take a look at the calendar on the syllabus. So we are currently at today, if we're going to do chapter 10 lecture today. This is got chapter 10, this is 11. I don't know why I still have this as chapters 10 and 11 lecture. It's weird. But anyway, a week from Friday, your Excel assignments are due. So you've got basically about a little over a week and a half to do that. If you've not started, start now. Okay, start now. Do not wait until the last minute. The doom of many people in this class has been waiting till the very last minute, like literally trying to do it the day of the assignment. That will not work. I will tell you 100% confidence that will not work. Okay, waiting the night before is not likely to work. It's possible, but it's going to be real more stressful. Please start working on that now. That way you can ask any questions, get anything clarified. That's one of those things that I want to make sure everybody is clear on. So please do not wait until the last minute to start your Excel assignments. Start working on these now. Reach out to my GTRA if you have problems, but make sure you've got all the information clarified. Also, I had mentioned this earlier in the semester. I want to go ahead and clarify something that's going to may or may not happen. I have currently not changed the syllabus structure, but I mentioned that we may have a guest speaker. If the guest speaker comes in, it would be on the afternoon of the 13th. Which basically would mean that we would not have the same discussion here. So I wanted to talk about what would happen if we do have a guest speaker and that will change things. I will know for sure whether we're going to change the schedule by the end of this week, but it does have an effect on some stuff next week. So let me just talk about what would happen. So currently, it won't change this week. Our plan for this week is still chapter 10 today, chapter 11 on Wednesday, homework on Friday. Currently, we're doing chapter 12 on Monday, chapter 13 on Wednesday, and then we'll do homework and Excel submission on Friday. If I decide to change the schedule, it'll be a small change for next week because I would have to move up the chapter 14 and 15 lecture. We would basically do our entire chapter 12 and 13, both chapters on Monday. Homework would be due on Wednesday, so it would be due 2 days earlier. And we would go over that in class, and then we'd start chapter 14, 15. We do chapter 16, which I didn't put up here, the following Monday. And then we do the guest presentation on the following Wednesday after that. I will update that if that happens. I will keep that updated, but I wanted to make you aware that there's a possibility that homework maybe do a little bit more quickly than usual next week, just to accommodate that schedule. I don't think that's a big burden, but I wanted you to be aware of it. Okay. Today we are starting we're starting our business processes. So we're going to start with the revenue process. And so there are a few things I want to clarify with respect to how you need to approach these chapters, and this will make your lives very easy. First of all, your majority of your focus should be on today's lecture and on a Wednesday's lecture. You should make sure that above all the chapters that we're going to cover, you have these two chapters down very well. Not just because these are the two most important business process areas, but also because they bleed into the other business processes. So we're going to be covering revenues today, and you should probably guess we're covering purchasing process on Wednesday. Obviously, those are the kind of lifeblood of the organization. Those are two of the major processes we covered in AIS, and we're going to have to cover those again when we talk about them in auditing. So if you're going to have a limited amount of time, I would make sure that you spend sufficient time on these two chapters and understanding of these two chapters. I'm not saying the other chapters are not important. I will say they are less important. All right. They are less critical and less detailed. These two are kind of the big ones. Also, because of the speed that we're going through these chapters, there will be one specific area that I will allude to that you will need to refer on your own, and I will give you the tables. You do need to do these references on your own. I will talk about them a bit in class. If you just rely on what I talk about in class and don't do the work on your own, you will have a problem on the exam, because I will tell you that the question on the exam will be specifically focused on these tables. I will tell you what I'm going to be talking, what I mean by that. There are basically 6 tables that you will have to review on your own, and I will specify each table when we get to them. Please make sure you spend some time reviewing those. I'm not saying that you should memorize those tables. I think that's actually an impossible task, okay? But I do think you should have some familiarity with them, and they relate very closely to controls and testing of controls. All right, so what is the revenue process? All right, well, when we talk about the revenue process, you've learned about it in AIS. It's pretty straightforward, pretty intuitive with respect to the sequence. The idea being is that customers are going to buy goods and services for that, and assuming that we're in a business-to-business environment, then we'll extend credit and collect upon those. So we can basically break down credit, or break down revenue process into 3 general process areas, okay? General process areas. First of these is going to be the obvious, which is going to be sales, okay? Sales are going to be the primary source of generating revenue for most organizations. Note this includes sales discounts. So these are going to be discounts upon the sales themselves. Like if you buy something on sale and go to a store and buy that. Next is going to be, assuming we're operating a business-to-business environment, we're going to extend credit to most of our clients, okay, to most of our customers. So extending credit means that we eventually have to collect the credit. So if we generate a receivable, we have to collect that receivable, which means that we have cash receipts. And then the minor one, those 2 are the major ones. Those are the 2 that we're going to focus on for this chapter. Oh, by the way, cash receipts also includes cash discounts, which, remember, that's the 110 net 30 type thing where you can have a discount for early payment. Also, we have a minor one. It's going to be returns and allowances. So return is when a customer says, this is not what I wanted, I return it. You cannot collect that receivable if somebody returns merchandise, simply because they don't owe you that anymore. An allowance is similar to return. An allowance is basically just saying that you're going to get credit for a particular transaction, but you don't actually return the merchandise. I think I alluded to this earlier in the semester. This happens a lot on Amazon when you buy something, when you buy some food merchandise on Amazon, you're not actually allowed to return perishable goods to Amazon merchants, so they have to issue credit. That would be an allowance. So a business process overview for the entire chapter. This is basically how everything relates to it. We're not going to focus too much on this diagram, but I did want to allude to it because it is in the book. So we're going to be focusing primarily on this one today. We're going to be talking about the revenue process. A lot of this stuff is going to seem fairly intuitive. So let's go ahead and take a step back to 302, talk about Dr. Ison's class. So revenue recognition. Revenue is defined as inflows or other enhancements of an asset of an entity, or settlements of its liabilities, or a combination of both, from delivery or producing goods, rendering services, or other activities that constitute the entity's major essential operations. So we will generally shorthand this and say revenues from goods and services, but for different organizations, this can mean different things. So that's going to be something important to note. The reason this is so important is that back in 2014, they started, and they didn't finish it until I think 2017 or 2018. They started on a new topic with respect to revenue from contracts with customers. Before this, revenue is recognized differently by different industries. And now this new revenue recognition standard says that there is one recognition model. The company should recognize revenue as they fulfill their promise to provide goods or services to their customers. And I'm relatively certain Dr. Ison probably told you the term that this is you refer to, but does anybody remember that term? recognizing the recognition of fulfillment, or recognizing that fulfillment. It's called performance obligation. Okay, performance obligation. So I saw a lot of heads. I remember that now, Dr. Barnes. You just had to tell me the words, and then it popped right into my memory. So performance obligation. So why is this so important? Well, principles are consistent across industries, which is really, really hard to do because many industries are very diverse in what they offer. The way that Taco Bell recognizes revenue is different from the way that Boeing recognizes revenue. There's a cohesive set of disclosure requirements. There's variable consideration included in the transaction price. So variable consideration will be any additional costs that are incurred that are generated through revenue. Identification of distinct performance obligations and how we allocate transaction price to performance obligations. So we're not going to get into the weeds about the different methods of recognizing revenue, but we do need to talk about the steps that are used in recognizing revenue. So there's a 5-step approach to revenue recognition that I'm sure you're pretty familiar with already. First step is identify the contract with the customer. Now, contract is not necessarily a formal contract like you learn about in Dr. or Professor Templeton's class, but keep in mind that anytime there's a business engagement, as long as there's two parties that both agree to a mutually beneficial transaction, there's basically an implicit contract. So if you got somebody who's selling, you got somebody who's buying, and they agree upon the terms of the exchange, then there's going to be the contract there. Step 2. Identify the performance obligations in the contract. So performance obligations can mean different things under different scenarios. Sometimes it's very, very simple. You go to Taco Bell and you say, I want my Mexican pizza. When they deliver your Mexican pizza, that's fulfilling the performance obligation. And something is more direct. If we're talking about Boeing building like a massive jet that they're going to deliver to a customer, there might be multiple performance obligations in that, which actually are distinguished or established within the contract itself. We also going to determine the transaction price. Okay, we want to know what the revenue recognition should be recognized for. Want to allocate the transaction price to the performance obligations in the contract. If there's only one performance obligation, it's easy. It's the entire price. Okay, if there's multiple performance obligations, we say, all right, how much revenue do we recognize at every single point in the performance obligation? Then finally, recognize revenue when the entity satisfies a performance obligation. So if it's one performance obligation, it's when that transaction is fulfilled. If it's multiple performance obligations, it's the steps at which we recognize performance obligation. We can recognize that portion of revenue. Pretty straightforward, but it's really, really important to remember this. Question always comes up. This is not auditing, Dr. Barnes. Am I going to ask questions about this on the exam? The answer is going to be a definite maybe. All right, because I think this is important for every accountant to know, to remember these details. I won't probably be as direct. I won't ask you like to list out the 5 steps, but I would expect you to have knowledge of the 5 steps, at least have them to there. I will tell you 100% there's not going to be a question, a short answer question where I ask you to list these 5 steps out. So that's important to note, but I do expect you to know what a performance obligation is and what its role is in this recognition process. All right, let's get into the stuff the auditor should know about. So auditors should be alert for the following activities that are fraud risks to revenue recognition. This is really important because the majority of financial statement frauds relate to revenue and revenue recognition. I'm not going to say all of them do, but I will say that the revenue is the easiest one to misstate if you want to actually try to put yourself in an advantageous position for a fraud. So let's talk about some of the common ones that we may see. First of all, there's side agreements, okay? And there's an interesting example of this in Exhibit 10-1 on page 337 of the textbook. The way to think about this is that you engage in a transaction with a separate party where both sides are trying to get something out of it that they would not have wanted otherwise. So the simple example would be is that you go to another company and say, hey, if you buy my product, I'll buy your product. Well, the question is would they have bought your product in the first place? And the answer is probably no. So that's an agreement that would not exist under other circumstances. That's considered to be fraud if that type of engagement takes place. Usually associated with side agreements come favorable terms or terms that are not necessarily consistent with what the stated price are in other arrangements. Another one's called channel stuffing. This is one of my personal favorites, not to commit, but to talk about. Okay. But when we talk about channel stuffing, basically what that means is that at the end of a period, an organization believes that they will not meet certain sales goals or certain revenue or income goals. So they create a whole bunch of fictitious transactions. They ship out a bunch of merchandise that people did not order at the end of the period. The period rolls around, the customers receive the merchandise, said, I didn't order this. And they say, so sorry, we'll go ahead and refund that. So they generate the returns. but the returns are generated in a subsequent period, in a period after the one. So they've inflated their sales and it's not affected their expenses. Related party transactions, these are fairly intuitive. Related party transactions, remember our responsibility as an auditor is to make sure related party transactions operate at arm's length, or at least the distance that arm's length transaction would. If we look at a related party transaction with respect to revenues and it is giving preferential terms to the related party, that's something that not only does the client have to disclose, but we as auditors have to be very, very wary about whether these are legitimate transactions or not. So all related party transactions are required to be disclosed. For revenue transactions, we may have to consider if there's additional fraud risks associated with such transactions. And then we have bill and hold sales. Bill and hold sales, basically, there has to be an existing contract for a transaction. So say you've got a customer that says, we're going to buy a certain amount of goods every single month. At the end of the period, they said the client or the audit client says, we're not going to meet our sales goals, so let's go ahead and let's just recognize the revenue that was going to occur in January. Let's recognize it in December. Then we'll just ship the goods out in January as before. This is obviously problematic because bill and hold sales violate that rule of meeting a performance obligation. You've not delivered any goods or services to the customer, so you can't recognize revenue. But it is a very common practice for organizations committing fraud to do something like that. They're just basically saying we're accelerating recognition of revenue. That's all there is to it. By the way, what does accounting say about the rule of accelerating revenue recognition? Is that a good thing or a bad thing? There was a rule you learned about that way back in Accounting 220 that said that that was a bad thing. What was that called? Conservatism principle? Yeah, accelerate recognition or accelerate recognition of expenses, defer recognition of revenues. Okay, yeah, that's the conservatism principle. Be more conservative in that regard. Okay. All right, so we talk about the revenue process for a retailer. That's the easy way to think about it. For the most part, cash sales are fairly intuitive because they only involve one set of transactions. So obviously, we're going to deal with the second one, which is a credit sale. This is something I've had to be very specific about in my language in my AIS class, and I want to make sure I reiterate that in this class. There's basically two types of scenarios that we can encounter, and generally speaking for this. We can talk about a business to customer environment. That would be like you going to Amazon and buying something. Usually when you do something like that, that's going to be considered a cash transaction and our cash sale. Now, even if you're buying for credit card, that's not actually buying on credit because somebody else is paying Amazon on your behalf. So Amazon recognizes that as a cash sale, even if you don't. The other environment is a business to business transaction. So this is usually where businesses do multiple series of transactions with one another. It's often inconvenient for a business who's ordering to just pay for every single transaction. So what they will do is they will extend something called credit. As you are well aware, when I talk about credit, I'm talking about a business-to-business environment. And generally speaking, the reason credit is extended is just for convenience purposes. It also creates a lot of problems with revenue recognition because when do you recognize the revenue? You don't recognize it when the cash is paid. You recognize it when the transaction performance obligation is met. It's also problematic because if you don't collect that, then you're just basically out of money. And it's hard to believe. I know that you're not going to, this is going to shock you, but not everybody pays for their goods and services as they probably should. Okay. Hopefully we try to minimize those amounts, but it's good, important to track that information. All right. So we're going to be talking about this over here, which is going to consist of our purchase transactions as well as our cash receipts over here. And we need to know how those relate into that. So as we're going through these business process areas, we're going to discuss the following topics to get a better understanding of the business processes. So we want to know the types of transactions and the financial statements accounts affected. I expect everybody to have fairly strong knowledge of this as you had multiple classes in this area, but it's just for reference purposes. The types of documents and records, I'm going to cover these at a very high level. I will focus on a few because I think they're important, but there's a big long list of these. You don't need to memorize the list, but you should be familiar with them. We're going to talk about the major functions, which are extremely important, and we're also going to talk about key segregation of duties, which is going to rely on how we characterize each of these functions. So let's go ahead and start out at the beginning, and I've already mentioned this area right here, the typical transactions process through the revenue process. We've got our sales transactions. That's when a customer says, we'd like to buy something from you, and we actually agree to that transaction. We generate a sale. In most of our scenarios that we're going to talk about in this class, I think it's almost all of them, but it's definitely most and maybe all. We're going to assume that we're operating in a business-to-business environment, which means the necessary extension of credit. So our second one is going to be the receipts of cash and customers from payment of goods and services. Technically speaking, this would also occur in the just a business to customer environment. We would just have that cash receipt occur automatically upon the sale. So there would not be a separation in timing of these two transactions. They'd be recognized simultaneously. Our third one is going to be returns of goods for customers with credit or cash. We do need to talk about this, but at a very high level, because this is generally not considered to be a major area of emphasis for most organizations. And we'll talk about why here in just a little bit. All right, so what are our typical transaction areas? For sales transactions, this is pretty straightforward. We're going to have accounts receivable. You'll notice it says trade accounts receivable. You don't need to read into that. That's just a fancy term for accounts receivable, okay? Sales, allowance for uncollectible accounts, and bad debt expense. So these are going to be our primary transaction areas. And then we also need to have this allowance for uncollectible accounts and bad debt expense. We're not going to go into the calculation of allowance for doubtful accounts, which if you remember from 303, it did that and didn't want to do it again. I feel you on that. It's kind of challenging. But we are going to talk about the intuition behind that, because that is a big area of emphasis for valuation, concerns around valuation. Cash receipts, this is pretty straightforward. We're going to collect cash and we're going to eliminate our accounts receivable. That's also where we would recognize sales discounts. I do not think that the sales discounts will come up very frequently in this course, but it's important to remember that this is where that would take place. And then sales returns and allowance transactions, we have sales returns and allowances, also accounts receivable, because remember, when you generate a return or allowance, you no longer get to collect that cash, or you no longer get to collect it, so you have to get rid of the receivable. All right. What are some documents? Well, some of the key documents that we need to know about, obviously the customer sales order. When the customer says we'd like to buy from you, they send us a document. We're going to have a shipping document, which is going to be evidence of we actually provide the goods to the customer. Sales invoice is obviously a big one. And then we have some other ones. Let's see, where is this? We have the cash receipts journal, which is going to recognize that, as well as the remittance advice, which is the actual document submitted by the customer to recognize that. Some of these other ones are also pretty important, but these are all higher level ones with respect to the specific documents. One thing I wanted to note with respect to these individual documents is oftentimes these will be aggregated together as part of the transaction process. And we will look at the information from a previous document in evaluating the accuracy of a subsequent document. So for example, I look at the customer sales order forms and I match that to the shipping document. I want to make sure that these numbers are consistent with one another, because if I'm sending out something different than what the customer orders, that needs to be specified to the customer. We generally call this process matching. Okay, we call this matching. You've probably heard me talk about it in 367. I will talk about it in this course as well. Anytime we can match a document to a previous document, we will try to do so. And oftentimes that creates an interesting paper trail that's kind of convoluted, but very important to follow nonetheless. All right, here comes the fun part. Major functional areas. Now, before we get into this, what I want to do is I want to go through just basically the functional areas. We're going to step back and we're going to look at these again, and we're going to classify these according to our segregation of duties. This is not a clean categorization. Our segregation of duties are not necessarily confined to one area, but for our purposes in this course, it makes it easier to think about them in that regard than just to try to look at them according to the definition of the process or the functional area. So obviously order entry, when we have a customer, we say we're going to, we want to buy goods and services from you, then we're going to enter the order in the system. The next step is to actually determine whether or not we want to do business with the customer. This is the authorization step. If we look at the customer and they've got great credit and they've got a history of repaying all the vendors they bought from, then we're probably going to say, good, we'll do business with them. If they've got a very bad history, they never pay their vendors back and their credit score is like 2, okay, we probably are not going to extend credit to them. We may still do business, but we'll say, you got to pay us in cash and it's got to be up front. All right. In that case, once we get the authorization of the transaction, then we're going to ship the goods out to the customer. Once that step takes place, then we're going to bill the customer. The customer is going to pay us back, hopefully, which means we get a receipt. And then we're going to have 2 different points where we recognize the transaction. We're going to recognize the accounts receivable subsidiary ledger and also the general ledger. And these are just different points or different levels within the system. Now, as I mentioned here, one thing that's easy, makes this process much easier to understand is to look at these and to try to figure out how they fit within segregation of duties. This is very advantageous to do for both the revenue and the purchasing process, because it makes things a little bit clearer to understand. So let's go ahead and do that, all right? So order entry. We have three types of duties that are separated out: custody of assets, authorization of transactions, recording of transactions. Which of these do you think order entry would most closely follow? Recording, yes, okay. Credit authorization, okay. Do you think this is custody, authorization, or recording? Authorization, yes, it has it in the term, okay. Shipping of goods, okay. Goods are inventory, which are assets, means this is probably what type of function? Custody function, okay. Billing, okay. Billing is basically generating an invoice, generating a document for the customer to actually pay. So that if we're generating a document, we're probably doing what? Recording, good, okay. By the way, make a note of this. This does not, we're going to look at this in the purchasing process, and we're going to have steps that are just the mirror inverse of this, and they closely follow this pattern. Billing and invoice processing are the simultaneous steps in the mirror. Invoice processing does not have the same segregation of duties function as billing does. We'll talk about why on Wednesday, but I want you to note that when we look at this on Wednesday, this is going to look almost identical, but it's going to have a small difference at this step right here. We'll talk about why, but this is a recording step. Cash receipts, cash is an asset, which means that we're probably talking about custody of assets. Yes, okay. And accounts receivable and general ledger, these are both recording functions. This is kind of confusing because these are recording functions, but they're recording at different points in the system. One is at the subsidiary level, one is at the organizational level. So they do affect different account areas, but it's important to note that we have redundant functional here. We have redundant function here, redundant recording. So why is this important? Well, let's go ahead and take a look at some examples of segregation of duties and how these work, okay? So the credit function should be segregated from the billing function. So if one individual has the ability to grant credit to a customer and also has responsibility for billing that customer, it's possible for sales to be made to customers who are not creditworthy, which can result in bad debts. So we don't want somebody who can actually provide approval in this area. And then also somebody who has the ability to record the transactions, because they could be recording transactions that will never get collected. All right. So what are the segregation responsibilities here? Well, I just said credit was that credit authorization function. So this is an authorization step. And billing, we said that's a recording step. So we're separating out recording and authorization within the same process area. The second one is not true segregation of duties because it says accounts receivable from general ledger. But remember, I said that these are two different points where recording takes place in the system. This is more of a redundant step to make sure if one gets recorded improperly, that it's checked by the other, okay? So this is not really segregation of duties, but they put it in the table here, so I'm going to talk about it. Shipping should be segregated from billing. What do we say shipping was? Custody. We said it was custody, and then billing is what? Recording. So we're separating out custody from recording, okay? So we want to make sure we're not sending out goods to people who are not going to pay for the transactions. So we could have unreported sales and transactions and theft of goods. So yeah, separate those out. Cash receipts is what? Custody. Accounts receivable is, yeah. So another custody recording separation. So within process areas, this is a very, very nice shortcut. It is not perfect. It is certainly possible that we could have one functional area that has multiple responsibilities. We will definitely see that in some of our subsequent business processes. But for revenue and purchasing, this is the easiest way to think about these, is to think about what their role, what their responsibility is, and why they should be separated. Also, I want to make a note. I'm really bad about mentioning this, but it comes up occasionally. If you have a responsibility in one process area, that does not mean that you can't have a separate responsibility in another process area. So if I have custody of goods over revenue, and then I have the ability to record purchases, that is not a violation of segregation of duties, okay? Because one is one process area, one is another process area. That's probably a bad example because I think that still probably would be problematic since it's over the goods. But the idea being is that if you have responsibility in one area, it doesn't need to not overlap in other areas. So I want to make sure that that's clear because that will come up a little bit later. All right. So what is our first step as auditors? We have to make sure that our client has properly addressed any risks associated with their business processes. Why do we do that? Is risk assessment a really important step in assigning controls? Yes. Okay. We've talked about that multiple times. So what are some specific inherent risk factors? There's 4 of these. The first one with respect to revenues is going to be industry related factors. As the industry changes, so the risks in the industry that can affect revenue flow. For example, if you're in a high technology industry and somebody releases a product that is just generally superior to yours, like if you're selling BlackBerries and Excuse me. If you're selling BlackBerries, then all of a sudden somebody starts selling iPhones, that's a problem. Okay. That's going to hurt your revenue stream. So that's something you have to consider. The complexity and contentiousness of revenue recognition issues. Even though we've got a similar industry standard for all revenue recognition now, and everybody has to follow that standard, that does not mean that revenue is recognized the same way across industries. For Taco Bell, recognition is easy. Deliver the Mexican pizza, revenue. Okay. For something like Exxon, for example, oil and natural gas, revenue recognition is an absolute nightmare. As somebody who's audited a company, an oil and gas company, I can tell you that's not something I really want to repeat anytime soon, okay? Because the revenue recognition protocols are really, really weird and very convoluted and complex. It does require specialists in that particular regard. Also, the difficulty of auditing transactions and account balances. If we have an easier time doing our job, then it's going to make this job more easy or job easier. I don't know why I said the easier time doing our job makes the job easier. Yeah, okay, there's a tautology for you. All right. If we have an easier time doing a job, that means things are going to be more effective. It's going to be lower risk. So we want to make sure that we can evaluate that. And then also, if there's misstatements detected in prior audits, we want to make sure that we're aware of that, because that is most likely an indicator there could be problems in the current period as well. So inherent risk assessment, both from the perspective of the client's operations and how it affects the audit, both are going to be very, very important. So next we're moving into control risk. So we're actually going to talk about a reliance strategy from revenue, which is intuitively sensible because most organizations generate revenue. Maybe if we had like a not-for-profit that maybe has one revenue transaction a year, that might be a scenario where we could say a substantive strategy. But for most of our scenarios here in this course, since we're talking about publicly traded companies, we're probably going to use a reliance strategy because there's multiple revenue transactions, many revenue transactions in a given period. So what we need to do is plan to perform test or controls on revenue transactions, and then we'll set and document control risk. So with respect to that, we know what our assertions are. Our assertions are going to be our account balance assertions. So that's all of our assertions with except the exception of which one? Or sorry, I said account balance. I meant transactions and event assertions. Excuse me. We're going to be dealing with our transactions and events assertions, which is all of our assertions except for, how quickly we forget, rights and obligations. Rights and obligations is the only one that's not included here because that's an account balance assertion. All right, so you've seen this before. I told you to know it. I told you to love it. I hope you've done both. Okay, we are going to talk from this perspective. This is the point where I'm going to tell you right now that I'm going to give you some examples, but you're going to have to do a lot of the heavy lifting on your own because we don't have the time to go through the entire table. So we're about to talk through two tables. You may want to make a note of this, okay? We're going to be looking at an example from table 10-6 and an example from 10-7. These are controls over revenue transactions and controls over cash receipt transactions. So let me set the stage for you so you are clear on this. Come exam number 3, there will be a series of questions where I will ask you to identify, based on a given control, what is the assertion that's relevant to that control, and what is a proper test of those controls, okay? So I'll give you the control, you'll have to tell me what is the assertion, and then you'll have to also specify what is an appropriate test for the control. I believe that's correct. I could be misstating, and maybe I give you the name of the control or the name of the risk, and you have to identify the assertion, then the control. It's one of those three, but these all are elements of the tables that I'm about to talk about. Okay, so please make sure you spend time. Like I said, there are 6 tables. Here are the first 2, 10-6 and 10-7. So controls with respect to revenue transactions. This is 10-6 on page 351. So what do you guys think is a very critical assertion with respect to revenues? What do you think is probably the most critical assertion? So, yeah, existence occurrence is most likely. It's likely that the client we're auditing will overstate their revenue transactions. They may create transactions that don't actually exist. Has that happened in the past? Have companies made sales transactions that didn't actually ever take place? Once or twice. It's happened once or twice. Okay. All right. So just like that really weird corner scenario where it's happened in history. We're going to talk about that revenue, that concern about revenues. So let's go ahead and talk about existence occurrence. What would be a major concern about risk existence occurrence? Well, as we talked about, fictitious sales, okay? So we have customers that don't actually exist. Somebody made up a sale, okay? So they said, we're going to make a sale to this transaction so we can inflate our sales and we can actually look good in our business results. All right. So what would be a proper control that could be integrated here so that we don't actually have somebody who's creating sales to fictitious customers? What would be an easy one? What's one of my favorite ones to talk about? Segregation of duties. Yeah, segregation of duties. Okay, yeah, segregation of duties. That's an easy one. So it's very hard to generate sales to fictitious customers if the person who's responsible for approving the sale is not the same person who's recording the sale or actually resulting in the shipment of the goods to the customer. All right, it's very, very difficult for that to happen because somebody's got to authorize the transaction and they will look and they'll say, I don't see this customer in the database. This is really weird. How did this customer make an order? So whoever's recording the order is going to have to say, all right, I made it up. I'm sorry. Send me to jail. All right. Proper segregation of duties would be a good way to address this. Good way to address this. By the way, this is not going to be the answer for all of our controls that we're going to be talking about here. I did mix it up a little bit, but I kept it easy for this one. Easy segregation of duties. All right. So first thing to note, we have to make sure that our management, our assertion, and our risk are consistent with one another. Would we say that sales of fictitious customers is a risk for existence occurrence? Yes, okay. All right. So our assertion and our risk align. Secondly, does our control properly address the risk? Would you guys say that if I segregated duties in this area of responsibility, that would reduce the threat of sales to fictitious customers? Yes, okay. So the control addresses the risk. Now, I will reiterate why this is important. The next step is to understand we as auditors have to test this risk, so we need an appropriate way to test this risk. So segregation of duties generally involves people doing different responsibility areas, right? So one of the best ways to actually make sure people performing different responsibility areas is to watch them doing it. What is that called? Observation, okay? Observation and evaluation, proper segregation of duties. Now, I know you're going to say, is an observation a low reliability test? And I would say, yes, it is, okay? This would probably not be the only test that we do, but that would be our starting point to get an understanding of what everybody's doing. We probably could do a reperformance to make sure that the responsibilities that everybody was supposed to be doing and what they should have done in every scenario were followed. But this would be a good starting point. And I won't necessarily ask you to say what would be the full set of responsibilities in this scenario, but I would expect you to have at least a good starting point evaluation. Now, the important point about this is that every single step has to follow one another, okay? You have to, if I give you the assertion, you have to know what the risk is, or correspondingly, if I give you the risk, you have to know what the assertion is, okay? You need to give me a control that is relevant to the risk addressed. Why is that important? Let's say I say a risk. Let's say, okay, say sales to fictitious customers, and you can say, okay, I'm going to calculate the valuation of accounts, the allowance for doubtful accounts. I'm going to say, all right, how does that address the risk? And you'd say, after waiting for a few seconds, I guess it doesn't, okay? The control has to be relevant to the particular risk that we're specifying. Similarly, when we as auditors do the testing, we have to specify that the test has to be relevant to the control. So one thing that comes up frequently when I say segregation of duties, I say, how do you test it? Somebody will write down, I'm going to inspect records and documents related to segregation of duties. And I'll say, that's fascinating. What documents are those? And you'll say, I don't know. I thought you knew. And it's like, yeah, I know what they are. They don't exist, okay? They may be documents that are actually in the client system that actually specifies client control documentation, but inspection records and documents deals with accounting records. What invoices specify segregation of duties? What sales orders specify segregation duties? What shipping documents specify segregation duties? You'll notice none of those do, okay? So inspection records and documents would not be an appropriate test to control in this area. So as you're working through these, you need to understand, why is this an appropriate test to control for this particular control? And that is the most important thing to note. When I ask you these questions, I won't necessarily expect you to have verbatim the answer of what everything is supposed to line up, how everything is supposed to line up perfectly. But I would expect if I ask you to give me a control that, or a test of a particular control, that you can articulate one that's reasonable, that you could justify. Observing segregation of duties is a good test because people perform these responsibility areas and I observe them performing their responsibilities on a given basis. So again, make sure you have that alignment. Does everybody understand? There will be different scenarios, like I'll have some multiple choice questions where I say, here's the response, here's the control, what would be an appropriate test for this control. I might have scenarios where I say, what would be an appropriate risk for these. There will be a lot of different scenarios for these. So yeah, you need to kind of understand the full series alignment. But I wouldn't panic too much about trying to memorize every single one. That's not what I'm going to ask you for. I'm going to ask you for things that should be intuitive if you have a good general understanding of all of these areas. All right, just to make sure, let's do one more. What do you guys say? All right, so cash receipts. Completeness seems like a risk, okay? Why would completeness be a risk with cash receipts? Well, if we have cash receipts that are coming to our client, somebody at the client could say, hey, look, somebody sent me a check. I could sign or I could endorse this check based on the company, and then I could take it and put it in my own pocket and cash it in my own bank, which would be a risk to do so because they'd be able to track who actually cashed the check. But ignoring that, it could be diverted, okay? So the cash itself could actually be stolen before actually being recorded. So cash receipts are stolen or lost before recording. That's a completeness issue, a completeness concern. All right, so what would be a good control in this area? We don't want cash as receipts to be lost. So we actually talked about it earlier in the semester. What would be a good system for something like this? Yeah, bank lockbox. Yeah, the use of a bank lockbox system. So what are we going to do in the bank lockbox system? What did Bill Boyd do? He did inquiry of management about bank lockbox policy. He went and talked to them and say, hey, how does this work? Okay, they send the money directly to the bank and then the bank sends you a list of remittances that match to your system. Okay, that's cool. Remember, Bill Boyd also reperformed those tests as well. Okay, he actually did some follow-up, so he didn't just let them go at that. But that's one that we're familiar with. That's one that we've talked about already. And it's pretty intuitive, pretty sensible, and it makes sense. All of these items are consistent with one another. All right, by the way, this is table 10-7 here. So just for context, 10-6 for your revenue transactions, 10-7 for cash receipts transactions. Those are the first two tables, 2 of 6. We got more coming, more coming. All right, sales returns and allowances. Man, I'm running way behind. Okay, I didn't realize that I'd been talking so much. Okay, so sales returns and allowances. I'm going to skip this step and basically tell you that I won't ask any test questions on this, but you do need to know this is generally not a material area of most organizations, which makes sense because most organizations are not going to survive if they continue having customers return their merchandise. The only time we jump in as an auditor is we'd say, hey, this is a material amount. Why is this a material amount? And that might reveal something important. All right. Substantive testing. What are we going to be doing? First of all, substantive analytic procedures and then tested details to follow those up. All right. So what would be some examples of assertions that we need to be talking about here? These are account balance assertions. Keep in mind that for substantive testing, that we can also have testing of our transactions and event assertions. Those are less primary than the account balance assertions because the time we reach substantive testing, we're more concerned about what the financial statement numbers are. We're usually testing those items. But we can test both of those conjointly. Those are discussed earlier. We call those dual purpose tests. For substantive analytical procedures, generally speaking, I don't put a lot of stock in substantive procedures over the revenue process. They can be helpful for some things, some information, looking at trend analysis. Like if we look at gross profit percentage over time and see how it changes, that can be something that's an insight for something we want to investigate further. But remember, we tried to do a revenue analytic back in chapter 5 and it didn't work out very well. That's one of the areas that we run into is that there's so much volatility and so many assumptions that go into try developing an analytic that other than doing trend analysis or ratio analysis, analytical procedures are not heavily useful, especially not model analysis. Don't worry, I promise you, analytical procedures will be very useful for some of our later business processes, just not this particular one. So you can actually look and see a detailed list of analytical procedures and revenue testing. Largely, these are going to be ratio analysis and trend analysis measures. All right, substantive tested details. What are we concerned about with respect to this? For completeness, all accounts receivables transactions have been properly recorded. Existence occurrence, account balance is not overstated with the inclusion of fictitious customer accounts or amounts. Accounts receivable or VAA, accounts receivable are recorded their net realizable value and the allowance for collectible accounts is adequate. So technically 2 there, but we want to make sure that both of those are valued properly. Rights and obligations, all accounts receivable are owned by the entity, okay? So this is an important one. Has anybody heard the term factoring before? I think I may have talked about it earlier in the semester. Some organizations, they may sell their accounts receivable to third parties so they can generate cash revenues up front. If a company factors their receivables, they cannot collect those receivables anymore. They no longer own them. So this would be a scenario where we want to make sure the accounts receivable are owned by the correct entity. Presentation, want to make sure the disclosures are made and account related to revenue and account balances. Classification is kind of a big one, okay? We want to identify and reclassify any material debits contained in accounts receivable. The word there, it's important, is material, because if these are large amounts, these are probably going to be reliant or something that the company is heavily relying on. If that's the case, then they're probably something more significant than accounts receivable. We might want to classify those as a different type of receivable that's more significant in scope. Not a long-term receivable per se, but something that's a lot larger, like maybe a note receivable. We also want to make sure we separate out long-term and short-term receivables because this might actually be relevant to debt covenants. Most organizations, they have an incentive to try to make sure that they have a large amount of current assets on hand because that usually improves their current ratios and their current liquidity measures. So if we as an auditor say this is not truly a current item, this is a long-term item, we might have forced them to restate those, to reclassify those. And then finally, I want to share the term and type receivables are properly classified. This is kind of the same thing as we talked about with the short-term and long-term, but it goes necessarily beyond that. Then cut off. All revenue transactions and regulated accounts receivable are recorded in the proper period. I went through that a little bit more quickly than I would, but I promise that we'll probably have some time to talk about the flip side of this when we get to purchasing. Generally speaking, you will notice that I talked about accounts receivable and I didn't really talk about the income transactions. As we're going to talk about later in this semester, most of the transactions that we or most of the type of testing that we do during substantive testing is going to be focused on the balance sheet, accounts, which makes sense because if I test the balance sheet accounts, I am also going to be testing the flip side of that, the revenue accounts. For example, if I'm testing an accounts receivable transaction, that accounts receivable transaction was generated by a sale. So I'm testing one side of the transaction. I am also testing the corresponding credit side of the transaction as well. All right, confirmations. This is an important one to talk about. I'm not going to do it justice, but we'll talk a little bit more about it later in the semester as well. Type of audit evidence is a direct written response from a third party to auditor by paper or electronic medium. Can address more than one assertions, but they provide for different level assertions for the different level assurance for different assertions. So if we're talking about accounts receivable or any other asset, generally we're going to be focused on existence is going to be our primary assertion. That being said, we can also get information on cutoff, completeness, and valuation assertions through that same confirmation. So confirmations can provide evidence on multiple assertions simultaneously. We will also talk about confirmations for liabilities and for equity. Those generally focus more on completeness than on existence occurrence, though they can test multiple assertions, which makes sense because if we're talking about our client with respect to assets, they're probably more incentivized to overstate their assets than understate their assets, which means existence occurrence is a bigger concern. We're talking about liabilities, they're probably more incentivized to understate those liabilities or equity, understate liabilities or equity. So completeness becomes a bigger concern. So we have two forms of confirmation we're going to talk about today. One is a positive confirmation. This is basically saying, hey, customer, or customer of our client, I should say, please send us a response regardless of whether you agree or disagree. So we send them the confirmation. We say, here's the amount. Is this correct or not? Please let us know. So this is a very high form of assurance, high level form of assurance, because the customer will always respond, or at least we'll try to insist that they always respond. If we don't need very much assurance, if we don't need to actually gain much assurance within a certain area, we could use what's called a negative confirmation. Okay. Negative confirmation is basically saying you only need to respond if the amount is wrong. As you can guess, this is a lower form of assurance because it's possible a customer may not respond just because they're lazy. So you should only use negative confirmations in the case where you don't need a lot of assurance, where you can have very low reliance on the balance that's posted. You think there's a low chance of misstatement. With respect to confirmations, the procedures, there are a few rules that we have to follow, and we're going to see these multiple times in the next few weeks. First of all, we confirm the interim date or year end. Usually if we confirm it at the interim date, we are also going to confirm at year end, just so we can have full coverage of the period. We also need to make sure that confirmation requests should be sent early in the engagement to maximize the response rate. So confirmation requests do need to be done as soon as possible because there's a possibility that we could have to reach out to a customer 2 or 3 times as possible to try to get a good response from them. The auditor must maintain control of the confirmations. The client can never, ever touch the confirmations. Why? Because if the client touches them, they could change the results, okay? We don't trust the client in any way, shape, or form in this regard. The client will never be able to touch the confirmations. If the customer sends the client back a confirmation and then they deliver it to our audit room, we have to tear that confirmation apart. It's no longer valid, okay? Has to come directly to the auditor when they're returned. Auditors should record when the confirmations are mailed, when they're returned, and follow up any unreturned confirmations. And each confirmation exception should be examined by the auditor to determine the reason for the difference. This is where we actually do our sampling and we determine what is the difference between expectation and we extrapolate that to the population. All right. I don't have time to go through the last 2 slides right now. So what I'm going to do is I'm going to finish right here on Wednesday, please remember, or please remind me that I need to cover the last 2 slides here because we got 2 more that are pretty important, but I'm not going to keep you till 2:25. So have a good day. I'll see you all on Wednesday.